Thank you for joining us this morning. My name is Kelly Swain. I am very honored to be serving as your president for 2 more months, and then I will gladly pass the torch to Ms. Stump over there. We have a really great speaker this morning, a very informative speaker this morning. And as I'm standing here, I'm realizing our Pledge of Allegiance giver is not here just yet. Chip, can I call on you and put you in the hot seat? Right? Luis isn't here yet, right? Okay. Chip, come on up. Thank you for being my backup.
Well, I missed it the last time.
Well, I'll step out of the way.
Okay. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. A great big hand for Chip O'Neill. Thank you, Chip. I appreciate you filling in. Okay. We'll just jump right into it without further ado. So, as many of you know who've been coming to our main meetings for years, we like to do an economic forecast in the month of November to give you an idea of what's to come, to help give you information and arm you when you're out on the streets talking to your clients. So we're very lucky this morning to have Jordan Levine. He's the Deputy Chief Economist at SAR. He helps to oversee all the housing market research at SAR, including market statistics, survey research, industry trends, and policy analysis for their legislative and their government affairs efforts. Jordan has a bachelor's degree in economics from UC Santa Barbara and a master's degree with merit in international economics from the University of Sussex. Before he joined SAR, Jordan worked in consulting as an economist and a director of economic research, where he oversaw all the research and economic analysis on California's economy and housing market, and regularly, there we go, slow it down, spoke to trade groups, public officials, businesses, and the media. As you'll see, unfortunately, he's not able to be here with us in person because of SAR staff policy, still no travel, but he's been kind enough to join us remotely. So check out our new technology features, right? We're loving this. Good morning, Jordan. Thank you for being here. Let's welcome Jordan to SAR.
Thank you so much. I appreciate the opportunity to be here and apologize that I can't be there in person. I look forward to hopefully being with you for the next one. And just keep in mind the camera adds 10 pounds, so it's not as bad as it looks. Trust me, when you see me again, we'll be in much better shape, and I'll be able to back that up. If I could get screen sharing, then what I'll do is I'll put up some slides. That way you don't have to look at my face, and we can look at some pictures, because we just released our 2022 forecast, and being that this is my kind of first year on the job with huge shoes to fill, replacing Leslie Appleton Young, or partially aspiring to one day do that replacement. But you know, if you think about where Leslie always started, I think that's the safest place for me to start as well. She always called it a cadence of accountability, and if we go back and look at what my forecast was for last year, I think it's helpful in kind of informing, both kind of how much stock you should put into this analysis that I'm about to share with you, but also to kind of underscore how it's really the story that's most important, because any forecast is only as good as the numbers that you're feeding into it, and of course numbers change all the time. And if you look at what we said was going to happen in late September, early October of 2020, for 2021, we were at a point in time where the pandemic was starting to normalize. We hadn't got to that big winter surge. And so we thought that sales this year would continue to go up by a little bit, about 3.3% to about 400 or so thousand units. We thought prices as well, after an increase of over 8% last year, would go up a little bit as well, right, to about 650,000. Well, unfortunately, as soon as Leslie and I gave that forecast at last year's Reimagine, it was pretty much dead on arrival, because as soon as we walked out of that event, California faced actually an unprecedented surge in COVID numbers, right? So the public health side, which had been normalizing after a pretty brutal summer, rose to all-time high levels and actually deteriorated. And what we saw pretty consistently throughout the course of this pandemic is that when the kind of public health numbers go south, the demand for housing actually gets stronger, right? And so actually we had a market that was reinvigorated, particularly during that final quarter of the year when things were really deteriorating in the broader kind of environment. And so right off the bat, actually, 2020 came in much stronger than what we had originally projected, again, largely on the basis of a very strong fourth quarter last year. And so we actually ended 2020 up 3.5% in terms of closed transactions to a level of almost 412,000 units. Similarly, prices weren't up by 8% like we had been projecting back in September of 2020. They actually rose by 11% to almost 660,000. So right off the bat, we were coming into 2021, on a much stronger tailwind than we had originally projected, right? And so when you look at our projection for where we're going to end this year, right, we're actually going to be up about twice as much as what we originally projected, at almost 7% increase in closed transactions from what was actually a much higher base to begin with of almost 412,000. So we're going to get up probably to an annualized level of about 440,000 units this year. The big part we missed was on the price side, right? Because instead of having prices that were going to go back towards the entry level as the market started to normalize, we had another, pandemic fueled surge, particularly at the top end of the market, that drove a 20% increase in home prices this year. We think we're going to average out somewhere close to $800,000. And so, that's actually much higher than the 1.3 that we projected. So, if I kind of give myself a grade on this forecast from last year, I'd give us about a C-, right? We kind of had the directions correct. We had sales going up, we had prices going up, but particularly on the price side, we did not see the kind of surge of 20% that persisted, again, largely because the that kind of surge in demand that really was reinvigorated because of the public health stuff. And so, again, you're only as good as the numbers that you're feeding in, but that's why the story is, again, the most important thing. And when you ask me about what's the forecast for 2022, you're really asking me a couple different questions, right? And we can try and unpack those. On the one hand, you're asking me just kind of about that broader macroeconomic environment, right? Is the kind of economic tide going to be rising? And yes, we're entering a period of heightened uncertainty, whether that's from, Evergrande or energy prices or the Chinese real estate market, inflation, what have you. There's a bit of uncertainty out there. We're generally pretty optimistic, barring some unforeseen shock, that jobs will continue to go up, that incomes will start to improve, and that will lead to more spending, a rebound or a recovery in the kind of retail component, the Main Street part of our economy. And we'll even see some of those life events that really spur changes in folks' housing choices start to happen again, right? When the economy starts to get better, then you can get married, you can have babies, you can get divorced, you can, move out of your mom's house or get kicked out or what have you. And so from a kind of 30,000 foot perspective, we're pretty optimistic that the worst of this crisis is behind us and that the kind of broader economic tide will continue to rise. But of course, that's just one part of the story. We also need to know how housing in particular is going to do, right? Because up to this point, housing has been the kind of bright spot in the broader economic landscape. Will we continue to punch above our weight? How about sales? Will those continue to go up? What about prices? Are we on the precipice? As I do these outreaches across the state, I'm starting to hear more and more the kind of brother-in-law effect, right? Where folks are waiting for the other shoe to drop, that there's going to be foreclosures coming down the pike because the eviction moratorium's out or the, foreclosure moratorium is off and what have you. To really, I think, understand what's going to happen with housing, we really have to kind of unpack which of the changes that have been ushered in as a result of this crisis are going to be more persistent, and where we're already starting to see things transition, not necessarily back to normal, but looking a little bit more like they did before the crisis than they did during the height of the crisis. Because we know that over the last 18 months, there really has been a significant impact on on the kind of shape of housing demand, the 5 W's, right, of what people buy, where they go, et cetera. And that's all being layered on top of an environment that had kind of pre-existing conditions, if you will. We had existing structural challenges in the marketplace that we'll talk about. In some cases, those challenges have been exacerbated by this crisis. And then, of course, the bottom line is, what does this all mean for me, right? As an individual real estate practitioner, having those conversations with our buyers and sellers out there in the marketplace. And there, I would assert that, you know, these structural issues, when we're talking about housing affordability, housing supply, home ownership, these aren't just things that impact our clients, they impact us directly as real estate practitioners. And I think that, you know, more so than ever before, it's kind of incumbent on us to really get serious about the structural challenges, because yes, the kind of cyclical effects of this crisis are going to continue to fade. But what we're seeing is that those structural issues, those pre-existing conditions are kind of reasserting themselves, and in many ways, again, have been exacerbated by the kind of the nature of this crisis. And we really got to get serious again about addressing supply and home ownership, because I think it's more urgent now than ever before. And that's kind of the recipe for success, because overall we're pretty optimistic, but at the ground level, it's still very much a kind of foot on the accelerator type of environment when it comes to your own individual business as a realtor out there. But let's talk about all the good news, right? Because there's the good news is relatively abundant, unlike when I was with you this time last year, and we were still kind of trying to guess what was going to happen. First and foremost is on the pandemic front, right? And you can see that after another nasty spike this summer, we've been moving in the right direction fairly consistently, and on a pretty significant basis. We've fallen down below, I think, 1,000 new cases there 1 or 2 times over the course of the last couple of weeks. So making good progress, and we know that does lead to broad economic recovery. We see that those retail jobs, those hotel jobs, as the crisis, as we get our kind of a lid put on that, do start to come back. The reason why I keep this as a wild card is because we're basically right in that same exact valley that we were at this time last year when I made the forecast, right? And of course, about a week later, we walked out and about midway through November, we saw this increase to unprecedented levels, which of course derailed the kind of broader economic recovery, but of course reinvigorated housing and kind of that renewed passion for home ownership. And so we're not in the same boat that we were last time. We don't expect that same kind of spike that we saw. But you know, I'd be lying to you if I said that this was my area of expertise. And so this is something that we're going to have to just continue to monitor, because, you know, not necessarily that it'll derail a kind of good housing market. It might actually reinvigorate the supply crisis, right, by driving even more people back into home ownership. But this is something that we've just got to keep an eye on. But overall, moving in the right direction, and that has led to relatively broad-based economic gains, right? So what you can see here is kind of a summary of California's labor market experience through the course of the kind of COVID pandemic. And what you can see is that between February and April of last year, we had the biggest shock to our economy of all time, almost overnight, casting off about 2.7 million non-farm jobs. But by April, we had kind of started to get our arms wrapped around what we were looking at in terms of this crisis. We weren't reopening the economy by any stretch of the imagination at that time, but we started to figure out, you know, again, get our arms wrapped around what it meant to do social distancing, wearing masks, the kind of protocol around real estate, et cetera. And we had, outside of that big surge in COVID cases from November that I just showed you, jobs have generally been moving in the right direction. We don't have the October data yet, but we did a few weeks ago get September numbers. And through September, we had already added back about 1.7 million of those 2.7 million jobs that we lost last year. So we still have about 1 million jobs or so left to get back to that kind of pre-crisis level of employment that we had in February. And we probably need another 500,000 jobs or so on top of that to not just get back to where we were, but to get us back to those long run trend lines where we should have been, but for this crisis. But when you put it all together, what it means is that we're about 55-60% of the way towards full economic recovery and moving in that direction on a fairly consistent basis, even as we still have a lot of healing left in front of us. So that's good news, right? When people are kind of, again, getting back to work, when their incomes start to rise, et cetera, that tends to be relatively good news from the standpoint of things like buyer demand, or even, supply in some sense, because you've got to be on a good economic wicket to be thinking about moving up, selling your home, et cetera, right? If you look at the kind of distribution of those 2.7 million jobs that we lost last year across industries in California, the strength of the housing market, I think, does start to make a lot of sense. Typically when the economy deteriorates, the housing market deteriorates, right? This time, not so much. You had a deterioration in the housing, in the broader economy that actually strengthened housing. And if you think about why, what I'm showing you here is that, again, that 2.7 million jobs that we lost broken out by industry. The red industries are the 4 lowest wage sectors in California. The green stuff is the 4 highest paying industries in California. And you can see that the low wage, kind of non-remotable, face-to-face jobs are really the ones that bore the brunt of this crisis. We're talking about leisure and hospitality, which is our bars, our restaurants, our hotels, right? Our retail kind of Main Street establishments. Other services is where all of our kind of personal care services are: your barbers, your nail salons, your hairstylists, your dry cleaners, et cetera, and administrative support, which are those kind of entry-level jobs that we use across the spectrum of industries. Those accounted for about 85-90% of all the jobs that we lost, whereas the green industries are high wage sectors like economic consulting, like architects, engineers, like computer programmers, like software providers in information, right? Management of companies, financial firms, et cetera, were much more insulated from the effects of this crisis. And those are the sectors, if you think about the kind of nature of California's housing market even before this crisis, that were really sourcing the vast majority of the home buyers in California. You kind of had to be in one of these relatively high wage sectors given supply and affordability, et cetera. And those were the folks that were relatively unaffected by the crisis. In addition, they kind of had this, again, renewed passion for home ownership, because we needed it to do, your home wasn't just a place where you went to sleep at night, grabbed a bite to eat, right? It's where you live, work, and play. It's your kid's classroom, it's your gym, it's your, your kind of social lounge where you're Zooming with friends from across the country because you can't leave your home. And you have this kind of increase in flexibility ushered in by remote work. And so you kind of had this perfect storm of relative economic insulation, this kind of renewed passion for home ownership because our homes are now more important to us than ever before, and the increase in flexibility. And you kind of threw that into the pot and you mixed it around with rates where, we started the year at 2.65%, and it really did create that perfect storm for housing demand. You can see here in the most recent weeks that we have seen mortgage rates start to rise, and they've generally increased, at a fairly slow clip since reaching those all-time lows where we started the year. But, I still like to remind folks that if you zoom this chart out to like a 50, 60 year long history, these are still rates that my dad would have killed for, right? Back in the 80s when he was walking around bragging about his 12.5% mortgage interest rate, right? That I think still outside of where we were at the beginning of this year, rates are still basically near all-time low levels, and will still, be a kind of selling point for those buyers out there, right? We are entering a period where rates, although we're not very pessimistic about how fast rates are going to go up, it is an opportunity to get in while rates are still at or below 3%, right? And so buyers who may have gotten discouraged, I think that this is something where, take a more zoomed out perspective, forget looking at it on a week to week basis. Rates are still very affordable by historical standards. Channel that inner Ira Levine. But if you kind of take that time machine back, these are the tailwinds that we were riding into 2021, right? And you can see here, just at the end of December, we were at a 15-year high for closed transactions. We had a 509,000 unit annualized pace, which, as I mentioned, was an increase of 3.5% over 2019, right? So even with all of the lost sales from March, April, May of last year, we more than made up for that lost ground in the second half of the year, clawing a lot of that back just in the fourth quarter, right? Where we made up again, we clawed all of that back and then some, even as we set what were then, all-time high prices of 720,000 with a 1.3, month supply of inventory out there on the market. So just riding an incredible wave, we saw that perfect storm of housing demand show up for us in terms of actual closed transactions and increased market competitiveness. As I mentioned, it did kind of shape or change the shape of demand in many ways, right? That this was kind of in some way shock induced housing demand. And we saw that both in our annual housing market survey that, in some cases, these are just our 1,000 home buyers that we talked to this year, but we asked, did the pandemic change your timeline for home buying, right? And half said no, but half about said yes, right? About a fourth, or right, 23% said, yeah, they couldn't buy. These are the folks who were impacted by the crisis. They had to wait and see what was going to happen with jobs, with income. But 26% said they actually bought faster. They bought sooner as a result of this crisis. And of those folks who actually made a change to their plan, that also ushered in a change in what they were buying, right? So we saw basically about 2/3 of those folks who made changes to their home buying plan actually not just change the timing, but change what they bought. And you can see that impact across a variety of different factors. If you look at the market in terms of geography last year, right? I talked about how California as a whole ended the year up 3.5% from where we were in 2019. We actually had 20 cities last year that grew by at least 40%, right? So it made up for more than all that lost ground, surging ahead. And if you categorize these markets, I would argue that they share, one of two common threads, right? They're either the yellow stuff, which are your very high cost, luxury type markets, whether primary or second home markets, or they were your kind of high quality of life, either resort or, either way, not necessarily large employment centers that offered, a high quality of life, or the ability for these, what I would call opportunistic out migrants who were relatively insulated from the effects of the crisis, who did have the option to work remote, right? Who were in those kind of high wage, relatively affluent industries that allowed them to take advantage of these opportunities to go to places like Big Bear, like Tahoe, like Arnold, right? Like Shaver Lake, like Indian Wells out in the Palm Springs area, or Rancho Murrieta, right? Tehachapi. We're talking about Sierra Nevada foothills. These aren't like dense employment centers. These are folks who, were able to kind of take advantage of those low rates and flexibility to finally get their foot on the property ladder for the first time. You can see the same kind of thing if you look at it not by geography, but instead by size of home, right? For the preceding 2 or 3 years leading into this crisis, the median square footage of a closed sale in California remained remarkably consistent. We stayed plus or minus 2% of about 1,740 square feet, about 99% of the time, right? But almost overnight, that number jumped up by about 90 square feet in the onset of this crisis, right? So these were folks who were moving to, areas that were a little bit further afield from where they had traditionally been living. They were buying homes that were a little bit bigger. To my mind, 90 to 100 square feet is about the size of a home office, right? And so you could kind of see this pandemic-induced demand that really pumped up the size home. You can see the same thing if you look at it not by size, but by condo versus single family, right? And this just is showing you the onset of the crisis. So this chart stops in June of 2020, because I want to highlight that when single family homes last year were shrinking by 30 and 40%, condo sales, which tend to be in those dense employment centers, right, which tend to be smaller in square footage, were shrinking by 40 and 60%, right? So all of these different indicators, in addition to our survey, tell us that there was this kind of pandemic-shaped nature to the demand that we saw coming into last year, and that a lot of these folks were indeed first-time home buyers. In fact, that continued into this year as well. Again, from our 2021 annual housing market survey, the percentage of the market that was first-time buyers remained relatively high. We were at a decade high level in 2020 of almost, or a little bit over 37% of the market, but that remained, at a decade high level outside of last year into 2021. And so we did see that perfect storm for housing demand did motivate a lot of folks to actually finally get their foot on the ladder for that first time and seek out that kind of American dream of home ownership. But if you look at who these folks were, again, they tended to be the relatively affluent long-term renters, right? Because for the second year in a row, we had about a third of first-time buyers coming into the market with at least 20% down payment. So these were those folks who were in these kind of remotable sectors with savings who, for whatever reason had rented for a long time because they wanted to walk to the office, because they weren't ready to make that change. They weren't incented by low rates or what have you. They finally made that jump. Conversely, if you think about it from the standpoint of like systemic risk, right? The percentage of first-time buyers that were coming in to the market with nothing down, were coming in with 5-1 option arms, was a kind of negligible share of the market, both by kind of absolute standards, right? We're talking about less than 3% of the market coming in with nothing down. But certainly in comparison to where we were at the height of the last bubble in 2006, right? When it was 2 out of 5 buyers coming in with no down payments. And that makes sense just from a practitioner standpoint, right? With so much demand and so little supply, sellers realistically aren't going to sit around and consider 0 down 5-1 option arm, buyers when there's, folks putting 20-25% down, waiving contingencies, et cetera. And so that kind of makes sense as well. But you can see the same thing if you look at it by income instead of down payment. You can see it if you look at it by credit score, right? That these are folks who make 6-figure incomes. They have 700 plus credit scores, et cetera. So it wasn't the kind of middle class scrap your way into the housing market. These were, again, those relatively affluent remote workers who were able to kind of take advantage of those low rates to achieve that dream of home ownership. It's even higher if you look at the repeat buyers, almost up to 200,000 now in terms of folks who are, selling and buying new homes. And that, I think, is, not necessarily optimistic from the standpoint of home ownership, but I think it does underscore this kind of renewed passion for, folks getting into the market when they may have kind of not been as passionate before about home ownership. That all makes sense, I think, through the lens of the economic data that we talked about, right? Where those high income earners in particular have been doing exceptionally well and punching above their weight economically. That's why these numbers also make sense, right? You're not just seeing a lot of these relatively affluent renters get their foot on the market for the first time. You're also seeing a lot of demand, from existing homeowners going out and buying more property, right? They're going to buy a second home. They're going to buy a vacation home. They're going to buy a property maybe that they want to put on Airbnb or what have you. And those numbers also went up for the second year in a row in our 2021 annual housing market survey. And again, to levels that weren't quite decades high, but almost, right? And so again, with the top end of the income spectrum doing relatively well, you see the top end of the housing market and also, a lot of these second home purchases continuing to do well. And that shows up when you look at the market statistics by price segment, right? So this is year to year growth in home sales by price segment. And you can see here that the top end of the market, 2 million and up, has been leading the charge. It's been growing head and shoulders above the rest of the housing market for the entirety of the recovery, right? Pretty much as soon as we opened the housing market back up in April, May, June, 2 million and up took off, right? In the face of those economic numbers that we just saw. And that continues to this day. Indeed, even as we've seen the overall market moderate down from where we were at this time last year, 2 million and up is still growing by 18%. And that's on the back of about a 70% increase at this time last year. So, those high income earners continue to do well, and that continues to dominate the housing market. In fact, we're now for the 5th month in a row selling more homes over $1 million than we're selling homes under 500,000. And that's the first time in history that we've been doing that. And it wasn't that long ago that 500,000 and below was the entirety of California's housing market, pretty much, right? Coming out of the 2008 financial crisis, we were in median price territory that was below, this is statewide now, that was below 300,000. And now we sell more homes over $1 million than we do under 500,000. This is all, of course, good news, I think, to folks in this room, both, because we're seeing kind of ongoing increases in home sales. This is, I don't know how this got in there. I don't know why this is in there. Am I not in my Sacramento stuff? Let me look at the right slide deck here, because I brought all this great local data for you. Well, let me jump past this. But, what you see in that kind of same vein of high priced markets, and I know I got the Sacramento stuff in there later on, is that, those ones are still the ones kind of generally dominating the growth, right? So what I'm showing you here is year-to-year growth in transactions. Each little dot here is a city in California statewide. And what you can see is that the faster growing cities tend to be associated with higher price.
Jordan, I'm
prices.
sorry to interrupt you. Can you hear me?
Yep. Am I no longer sharing my slides?
We are no longer seeing your screen. Yeah. Would you mind doing that for us one more time? Thank you.
Let me do it one more time. This is going to be better for everyone. There we go.
Got it. Thanks.
You bet. So yeah, so what you can see here is that, the farther you go out to the right, the taller these dots go, right? Meaning that we're seeing more growth in higher priced markets. And so that kind of relative outperformance on the economic side of those top income earners is still showing up through the first 9 months of 2021 in terms of closed transactions. In fact, if you kind of summarize all 500 or so of these dots that I'm showing you on the left-hand side, and just look at the top 100 fastest growing cities this year in terms of sales, about 3 out of 5 of those cities are cities with median home prices in excess of $1 million, right? 18% of these top 100 fastest growing cities, about 20 of them are cities with at least $2 million median prices. And so, that's why I said some markets are kind of going to be more normal than others going forward. I thought it was appropriate to do an Animal Farm reference there, but I also think that we can expect this kind of top end of the income spectrum to continue to outperform, shall we say, the rest of the economy. And that is continuing to kind of shape housing demand moving forward. But what's interesting is that if you look at the growth in transactions, these are those same 500 dots that I was just showing you on a map geographically, right? And here the green stuff are markets that are growing by about 30% or so on a year-to-year basis. The yellow stuff are markets that are growing by 10 to 30%. Red stuff is cities that are actually declining in transactions. But if you look at where most of the green and yellow is, right, it's not out in South Lake Tahoe. It's not all in Truckee or along the kind of Sierra Nevada foothills. A lot of it's in the core Bay Area, the core of Sacramento, MSA even. And I know nobody in this room cares about Southern California, but I brought the data just to kind of illustrate the same trend that we're seeing, right? That yes, you're still seeing markets like Big Bear and Palm Springs with some green out there, but the vast majority of the areas that are growing in Southern California this year are where most of the jobs have traditionally been located. And so I think that, again, both of these things are kind of music to the ears of the local economy. You can see just on a regional basis, right, that while California is up about 17% or so this year through the first 9 months, the core is doing even better than that, with the Bay Area, Central Coast, and Southern California kind of leading the charge. Here's the data that we actually care about. But you can see that actually, while the state as a whole is up by, a little bit less than 17%, we're kind of tracking right on par with that. What's a little bit different in the local market, and these are sorted from lowest price all the way down to highest price and Folsom, is that you don't see the kind of overperformance in the higher cost markets, right? Like Rancho Murrieta was one of those markets that was on my top 20 fastest growing cities last year, right? It's actually not seeing that same kind of growth in transactions this year. Most of the growth is actually happening in the kind of top half of this table, the markets with median prices down below 500,000. To me, that's a an optimistic sign that maybe Sacramento is kind of on the leading edge of seeing this kind of resurgence on the kind of entry level side of the market. I think in some cases, this is the most inventory constrained part of the market as well. And so we'd be growing even higher if we could get some listings flowing in some of these lower cost areas. But you see the same kind of story. This is now days on market, right? That's what I'm showing you on the map here is days on market. And this is the whole Sacramento MSA. So I included YOLO and El Dorado and stuff, but look at where the red is, right? Look at where most of the red is. That's the fastest median time on market, right? It's clustered around the center of the market, right? It's not all out in South Lake Tahoe or in Truckee, right? Like the fiercest competition again is kind of right where all of the action is. And so, in some ways we're not going back to normal, but you're not seeing this kind of everybody pouring out into Rancho Murrieta and Truckee and et cetera, in some of these farther afield places. The demand is starting to migrate back to the places where there's actually restaurants to eat and things like that, which are, I can attest are becoming more important as we're allowed to go outside. Unfortunately, more normal also probably means slower growth, right? And that's something that I want you to be cognizant of as I'm, optimistic that the broader economy is going to continue to get better, right? When you look at the effects of having been so inventory constrained for so long, that has taken a toll on home buyers out there, right? In the face of the initial impacts of this crisis, we had the percentage of consumers, and this is our monthly consumer sentiment survey, say that it was a good time to buy a home. Those numbers were going up. They actually went up to about 1 out of 3 consumers that we talked to by last summer. But as the supply crisis persisted, as prices rose by double digits, as median time on market fell into the single digits, you had a lot of folks who were getting out competed, right? You had buyers who were coming in paying all cash. They were paying more than 20% down. They were waiving contingencies, and folks were not getting those homes. They were putting in lots of offers, looking at lots of properties, and then they kind of fall victim to the brother-in-law effect that says, forget it, just wait and see what happens. The foreclosures are going to be coming anyway, et cetera. And we saw that over the course of the last year or so, the percentage of folks that thought it was a good time to buy has been cut in half. It was actually a few months ago down at 17%. It's improved a little bit since then, but I think that's going to be our challenge, is talking buyers back into the game, realizing that there's probably not going to be a huge wave of foreclosures that are going to save you a boatload of money. What you're going to end up doing is waiting for a couple of years to just pay higher prices at even higher interest rates, which is kind of the 1-2 punch for your pocketbook if you sit around waiting. But that buyer fatigue is real, right? Because we've now had 23 weeks in a row where we've seen fewer buyers, prospective buyers filling out mortgage applications, right? Those have been falling for 23 weeks in a row. And unfortunately, that does a fairly good job of predicting growth in our weekly closed sales index here in California. The good news is those numbers are starting to decelerate. And I think we got to get our buyers back focused on the prize of how low rates still are, and the fact that, most projections have prices going up even faster than what I'm about to show you. And so you're not doing yourself many favors by waiting, but we should expect that pace of sales to normalize, right? Because a market that's not kind of shock induced is probably a market that means we're not able to hang on to those 15-year highs. And indeed, you see that even as we're kind of stabilizing at levels that are slightly higher, actually about 5 to 7% above where we were before this crisis, it's also true that we're not just coasting along at 510,000 units. And that kind of normal means that some of those structural headwinds that prevented us from getting above 420,000 sales for the previous decade are going to reassert themselves, right? And so the good news is that more normal probably hopefully means a few more listings out there, right? We're still hugely depressed in terms of active listings, even by 2018 and 19 standards, which weren't the best years for housing inventory. But this light green stuff at the end has been moving in the right direction. I'm encouraged by September, which didn't drop down as much as a September normally does, right? So maybe that seasonal cooling, will be propped up by all this pent up supply of folks who maybe have wanted to sell, but were scared to. up to this point in time. And I think that that is something that we can probably look forward to as well, right? That even now, buyers have a few more options again, right? And so I think that we can kind of point to that to our buyers and say, yes, I know you've gotten sick of being out competed, but we're, there's options out there. We're going to get you in a home. Rates are still really low. There's a few more listings. Indeed, the market's not quite as ferociously competitive as it was 6 months ago, right? We're still, and don't let anybody tell you this is a cool market now or that the market's cooling, right? Because as you can see here on the left-hand side, the percentage of closed sales that are closing above list price is still 62% of the market last month, right? So we're still talking about 3 out of 5 homes selling above list price, but it's no longer 75% of transactions, right? So there is, even just a little bit of listings makes a huge difference. And I think, this is good news for me because it means markets still work, right? When you have such a long inventory constraint that persists for such a long time that, it drives economics 101 to reassert itself, right? That prices go up a ton, you get a little bit less buyers, right? Demand shrinks back. You also get a little bit more supply. People look out and go, oh my gosh, I could sell my house for a good price, and they sell quick and I don't have to negotiate, right? And that kind of market mechanism is in fact working. And you see the same thing in days on market, that yes, homes are still going pending on median in less than 2 weeks, but they're no longer going pending in less than 1 week, right? So you have a few more options. You don't have quite as much ferocious competition. You have a little bit more time to get your ducks in a row and get in there. So, again, not a cool market, but I kind of joke that we're just not at those kind of bubbling, frothing, white hot levels. And we're just back to plain old run of the mill, boring, red hot, where we always are with a kind of excess demand type of situation. And that's why even as prices are still near all-time high levels, 810,000 roughly last month, they're only going up by 13.5%, not 35% like they were during the summer, right? And I think that ultimately is a good thing, both for this kind of sustainability of the market, but also I think, it's time to get our buyers back into the game again. So we're not going back totally to normal. We're still seeing growth in markets like, Arnold and South Lake Tahoe and Big Bear and stuff like that. But we're also starting to see a lot of the demand migrate back to where it was before the crisis. The reason why I kind of don't just end there on the good news, right, that everything's going up, is because I want us to be very much proactive when it comes to how we deal with clients, because, our pre-existing conditions, as it were, have been kind of made more urgent by the nature of this crisis. You can see that the percentage of sellers who sold a home and left California completely went up in 2021. This is a long-standing trend, right? These numbers have been going up pretty much since the market hit bottom back in 2012 or 13, but it went up faster in 2021, right? So this long-standing trend has been accelerated by the nature of this crisis. The jump up in 2021 is going up by more than it has in preceding years, right? So this crisis is accelerated our long-standing trends. You see the same thing if you look at the question in reverse, right? The people who sold a home and then bought another home in the exact same county. That used to be, roughly half of sellers. Now it was less than a third for the first time since we've been asking this question going back about 16, 17 years. And so, that kind of flexibility, that remote work is kind of intersecting head on with this increased, passion for home ownership, and folks are making it happen. And if they can't make it happen right next to where their jobs are, then they can make it happen somewhere else. And in fact, even as we don't have 2021 data from the Department of Finance yet, they largely corroborate, even with their 2020 data, what we saw in our annual housing market survey, because we had a 261,000 net out migration from California, right? Again, the trend, longstanding trend, accelerated. We had, for the first time in recorded history, California's population actually declined. That's problematic, right? Not just for us as real estate professionals, but for California's economy, right? How do you grow an economic base in a shrinking population? All you got to do is look at places like Japan to see how big of a challenge that is to overcome, even with the most productive workforce in the world. And I'll get up on the soapbox, while I have the captive audience to kind of really lay this at the doorstep of our lack of construction, because even with a 20% increase in projected construction this year, we're still falling 60,000 units short of the level we need to build by the state's estimate just to tread water on housing affordability, right? Think of the 180,000 as like, that's the amount that we need to build just to make the interest payment on our credit card, right? Forget about chipping away at the balance that's accumulated over having only ever hit that level of permitting 5 times in the last 35 years, right? 180 is what we need just to make the monthly payment, right? And so again, even there, we're just falling, woefully short. On top of that, the homes that we do have don't turn over, right? Because where are you going to move? We got rid of the kind of property tax penalty associated with moving with Prop 19, but you still got capital gains. You still got a 2.65 potentially % mortgage that you don't want to give up. And more importantly, you've got nowhere to go. So we see people staying in their homes twice as long as before. That's the double whammy from a supply standpoint, right? Because we not only don't have enough homes out there full stop because we haven't built anything, but the homes that we do have out there never end up hitting the MLS because people just kind of hold on to these precious resources, with a kind of death grip, unfortunately, and it leads to all these negative consequences in the marketplace, including an erosion of housing affordability. We haven't released our third quarter number yet, but even in the second quarter, with the lowest rates of all time, housing affordability deteriorated, right? So prices more than canceled out the benefits of low rates. And now we're entering a period where rates are going to continue to go up. And so that's just going to, again, be the double whammy for affordability, for home ownership, where we already had a 10% percentage point gap with the rest of the United States, particularly in segments of the demographic that are going to be so critical for housing demand moving forward. And again, not to kind of beat a dead horse, but you really can draw a straight line from there to, the lack of construction to all these negative records that we hold on housing, whether it's low vacancy rates, housing inventory, housing prices that make the rest of the nation cry. The number of people that live rent burden, the number of people that live in overcrowded housing. These are areas where we're like the second worst state in the nation. Poor people, we're the worst in the nation once you account for cost of housing. And again, it has impacts not just on our clients, but on us as well, right? Because we've gone from a situation where we were a 25 million person state a couple of decades ago to now being a 40 million person state, roughly. We've seen the number of realtors in that time basically double. And yet we've seen the pace of new construction be cut more than in half, almost reduced to a third of what it was back in the mid 1980s. And that's why even in a market where we hit kind of 15-year highs for transactions and all-time high prices, we're not really selling any more homes than we used to sell back in the mid 1980s. And so, those structural issues impact the market. They impact our clients through affordability and home ownership, but they also impact us as real estate practitioners as well. And that's why if you kind of look at the tail of the tape over the course of the last couple of years, that, top producing agents did better than ever, right? That this kind of surge, this renewed passion for home ownership really benefited folks that were, already doing well as real estate professionals. In fact, if you look at the mean income last year, you add up all the commissions, you add up all the realtors, and you divide the two, that number actually went up by 16%. But if you look at the median income of a member last year, that number actually went down by almost 17%, right? And so in some ways, that rising tide has only lifted some boats. And that's why even as I'm relatively optimistic, the goal is to kind of keep a foot on the accelerator type of mentality, because yes, we think the economy will continue to get better. GDP going up by 4%, another 3% increase in non-farm payrolls. California, in fact, will outperform that, growing our labor force and employment base by almost 5%, with an even bigger decline in the unemployment rate, even as population starts to get back on track. And yet, if you kind of superimpose that onto the housing market, we don't have that resulting in a 15-year high for transactions. We have sales that are going to remain, at or above pre-crisis levels, about 420,000 units, but that's going to be a 5% decline from where we were or where we're going to be this year. And yes, we still have prices going up. It's all due to a lack of supply. But again, those structural challenges are going to prevent us from kind of being able to operate in a kind of cruise control environment as individual realtors. The good news is that, yes, the stuff that we want to be moving in the right direction is that economic tide is rising. We have a lid on the COVID numbers. Buyers are still super pumped on housing, right? Probably more than ever. And the market statistics, I think, are still supportive of both more buyers and more sellers, which is why we have stable sales and rising prices. But, you know, I got to keep it really real with you that we have to get serious about housing supply, right? Because we haven't been building enough for a long time. And now it's even more urgent than ever before that we do so, because folks have a renewed passion for home ownership. We see that in the first time buyer statistics, but there's a lot of headwinds out there preventing folks from being able to achieve that. And that's before we even talk about, the DOJ and NAR and portals and the MLS and all the other industry stuff that kind of is going on in the background. And so, yes, the broader tide is rising, but no, it's not lifting every single boat. So this was kind of me this whole hour, and hopefully that is you. And I think that if you kind of keep your nose to the grindstone, that all those kind of tailwinds are there for continued growth, but you just don't want to take it for granted and keep your foot on the accelerator. So I thank you so much to Sacramento AOR for having me, and look forward to being with you in person next time. But I'll leave it there and say thank you so much for your time.
Thank you, Jordan. Super informative. We appreciate it. Do you have can you hang on for 2 minutes to see if anyone has any questions?
I always love to see if people have questions.
Okay, does anyone in the audience or at home, Aaron's on the keyboards over there, so if anyone on Zoom has a question, type it into the box. Aaron, you got one? Hey, Jordan, your favorite question. When are all those thousands and hundred thousands of foreclosures going to hit the market?
Love that you asked. If I may, I'm going to share slides because I almost knew that someone was going to ask this. So I actually, and I'll send these all along after the fact, but I brought an appendix with all of my foreclosure numbers at the back because, the point for me on foreclosures is that we had a much different set of fundamentals coming into this crisis than we had going into the last crisis. It's an unprecedented crisis, no doubt. But it's one that was happening to what was otherwise a relatively healthy economy. First point on that front is what the kind of econ nerds call the financial obligations ratio. This looks at both debt, which is the dark blue, but also debt and broader financial obligations, which is the light blue, both measured as a percentage of current incomes. And what you can see was that in the wake of this crisis, households in the wake of the last crisis, 2007, 8, 9, it really caused U.S. households to get their financial house in order. You couldn't carry around as much bad debt. And in fact, coming into this crisis, we weren't just at kind of pre-2006 levels of financial obligations. We had folks who had the lowest levels of financial obligations relative to how much money they were making, in the kind of 40 years that they'd been looking at those numbers. The other thing is, you can look at the same thing in reverse, right? Savings rates, which had fallen basically to less than 2% nationwide, right? Like back in 2006 or so, a savings account was just a thing that your grandma put money into on your birthday, right? But now Americans actually rebuilt savings accounts again in the wake of that crisis. So there was just more kind of financial wherewithal. We didn't have our kind of backs against the wall, so to speak, financially as just U.S. households, right? Where we were kind of so levered up, whether it be on boats and motorhomes and cars. That's point number one, right? The other thing is, again, I showed you this stuff in my regular remarks, but buyers came in with much more skin in the game, right? People were putting down payments in again, right? We didn't have people coming in with the kind of 0 down, 5-1 option arm, ticking time bomb type of mortgage products, right? They were coming in with, they had their own vested they had a dog in the fight, shall we say, when it came to their home because they had their life savings in that home now, right? And that is another huge source of stability. The other thing is, they kept the equity in their home. This goes up through 2021 when we did see folks finally start to cash out. That's what the blue bars are, right? But still, even in 2021, a level of cash out refining, even though prices, keep in mind, were way higher than they were even at the peak of the last bubble, were a fraction of the cashing out. So they went in with more skin in the game. They didn't cash it all out and go take their family to Europe and, go on that cruise and buy the boat and what have you. And so again, still had that kind of dog in the fight. You could see that's a much different scenario than where we were in 2005, 6, and 7, when we were so rich in our homes that we went out there and kind of, indulged ourselves, right? The other thing, and that's why you already see delinquencies peaked at half the level they were at back in 2008, 9, right? And have been coming down already for the last 4 quarters in a row. If you look at our forecast, we look at the forbearance numbers and project out what we think is going to turn into an REO number. And you can see that that number barely even shows up on the graph relative to the 1.1 million foreclosures that we had back in the kind of 2008 to 2010 timeframe. Even if I, forget all the fancy analysis that I did on the forbearance numbers, even if you just look on the right-hand side at every single mortgage that ever went delinquent at any point in time, forget if they've already caught back up, sold the home, whatever, just like ever went delinquent at all, even if every single one of those people foreclosed, you're still talking about a foreclosure number that's a fraction of where it was last time. And so, yes, it's an unprecedented, shock, but it's not a housing-led downturn, right? We weren't at the root of the crisis with a huge shock, Bear Stearns, Lehman Brothers, just really getting the snowball rolling on what were already deep fundamental imbalances, right? Huge shock, terrible fundamentals, right? Now we have a huge shock, great fundamentals. It prevents that snowball from cascading into all this kind of, additional knock-on kind of what the econ nerds call externalities. I think, if you look at prices, they're elevated relative to where they should be, but nowhere near the double that they should, were last time. If you do that kind of comparison, and this is just that green stuff is like a hypothetical, where would you expect in an ideal world for prices to be given where interest rates and incomes are? And yes, the actual price is higher than that green number. I'm showing you the gap between the actual price and that green line. And you can see that it's about 36% above. It's always about 20% above. It's nowhere near more than double where it was last time around. So there's some systemic risk, even in a kind of all bets are off kind of scenario, right? And a bottom falls out of the market kind of environment. You're still talking about the potential declines being much smaller, right? Because there's a limit to how far down prices can go when incomes and interest rates are where they are, because a lot of what you see in prices is, justified, shall we say, by the amount of high income earners and low rates that we have out there. Prices are a little bit higher than what you'd expect to see in a kind of perfect world. But, look at where they were back in 2006. Prices were more than twice what you would expect to see if you just did a back of the napkin calculation on incomes. And so, even if I don't know what I'm talking about, shall we say, I think the downside risks are much smaller. I think the bigger risk is on the stock market side, but I won't go farther than that. I knew I should have brought those for a reason.
Thank you so much, Jordan. Next question is, where do you see interest rates going?
Yeah. So, and those are on the slide. I knew I was going on forever, so I didn't want to belabor those, but we have that in the forecast slide, which I'll send around. We have our 2022 annual number at 3.5%, which means we're probably going to start the year somewhere close to where we are right now, about 3.1% or so, starting in January, maybe get up to 3.57, 3.8% by December or so. So we do see rates increasing, but we're not really pessimistic. We're kind of on the relatively modest interest rate forecast scale by other by other forecaster standards. And I'm just not totally sold on this big kind of permanent increase in inflationary pressures. I do think that the Fed will start to kind of act against inflation and kind of taper, if you will. But I still look back at the kind of December 2019 economy that we had, where we were at all-time low levels of unemployment, and the Fed still had rates at a very low level, and they couldn't get CPI to grow by more than 2%. I'm not sure exactly what's changed to make that fundamentally different going forward.
Thank you, Jordan. One last question. Rico, you have one more question? Were the stats you were showing, those are all California based, not nationwide?
All of the stats I showed were either California based if it wasn't specified, or like the local stats, which were by city in Sacramento.
Thank you, Jordan. All right, we're out of time. Thank you for joining us this morning, Jordan. We appreciate it. Round of applause here if you can't hear it.
Thank you so much.
We look forward to having you back next year. Thank you so much.
Thanks.